The dollar machine is entering its final phase, the four-stage pattern that always ends the same. The most important thing happening in markets right now is not a headline, not a rate cut rumor, not a quarterly earnings beat. It's a structural phase change in the monetary regime, an engineered transition that follows a repeating sequence so reliably it might as well be a math problem. When the reserve currency system reaches the point where the liabilities grow faster than the productive base that supports them, the system doesn't solve itself through optimism. It resolves through repricing, through stress, through currency pressure, through forced policy choices. Recent estimates put total U.S. federal debt in the rough neighborhood of the mid-30 trillions, while global dollar usage, debt, trade invoicing, funding markets, creates dollar obligations that sprawl far beyond U.S. borders. That's not a political statement. That's a balance sheet statement. And balance sheets don't care about narratives. The inevitability is this. Once the funding requirement becomes too large to clear smoothly at tolerable yields without extraordinary liquidity support, the next phase is not optional. It's the next step in the pattern. The pattern has a fixed shape, and it always shows up the same way, even though the costumes change. First, there's a clean foundation, a new monetary framework, a peg, a treaty system, a reserve arrangement, a rules-based architecture that restores confidence and makes credit expansion feel safe. Then comes the expansion phase. Credit multiplies, deficits become normal, leverage becomes invisible because asset prices rise and volatility falls, and the currency's credibility is quietly mortgaged for growth. Next comes the loss of control, and the terrifying part is how boring it looks right up until it isn't. The early symptoms are plumbing. Weak auction demand, a repo spike that gets shrugged off, a widening cross-currency basis that most people never track, a sudden premium for immediate delivery in a commodity that should be liquid, a central bank statement that reads like confidence while the market hears desperation. You don't get regime change with a drumroll. You get it with quietly rising term premia, with larger and larger refinancing waves, with maturity walls, with a system that needs ever more liquidity to function the way it used to function on autopilot. In that environment, FX is not a sideshow. FX is the scoreboard. It's where the world votes, in real time, on the credibility of the promises embedded in the currency. To see why this is predictable, you have to look at moments when monetary systems were forced to reconcile promises with reality. Take Germany after the First World War. The foundation stage was not confidence, but it was an imposed structure. Reparations, obligations, formalized under the Versailles framework, a state trying to reassert normalcy, and a central bank apparatus, still treated as an authority, asked to bridge an impossible gap between internal stability and external payments. The public was told the system could work if everyone remained calm, if production returned, if fiscal order was restored. That's how these things begin, with a framework that sounds administratively manageable, even if the math already says otherwise. Then expansion and debasement arrived the way it always does, through the attempt to finance the unfinanceable. Reparations were payable in hard currency and goods. The domestic economy generated marks. The state needed marks to pay domestic obligations, and needed foreign exchange to satisfy external ones. So it did what states do under pressure. It leaned on the central bank. The Reichsbank expanded the money supply. Credit grew, prices rose, the currency weakened. But in the early phase, it felt like a relief. Money was available, wages could be paid. The economy didn't immediately collapse, it simply began to slip. That's the seduction of the expansion stage. It postpones pain by pulling it forward, and the bill shows up later in a different form. The loss of control phase is where the FX market becomes a weapon. A currency that is being expanded to cover fiscal gaps can't maintain external value unless someone else is willing to absorb the inflation. Foreign counterparties aren't charities. As the mark fell, import prices rose, feeding domestic inflation. That inflation eroded real tax receipts, which forced larger nominal issuance, which required more money creation. An accelerating loop. Attempts to impose order collided with reality. By 1923, the crisis was no longer abstract. It was visible in daily life. Prices changing within hours. Workers paid twice a day. Savings vaporized. But what made it a regime event was not merely high inflation. It was the break in trust, an understanding that the state's liabilities were not stable claims on future purchasing power. In bond terms, the real yield went deeply negative. In currency terms, the exchange rate became a collapsing signal. Now watch what happens in that final stage, outcome, because it's where the template becomes obvious. The system didn't heal by asking politely, it was replaced. The Rentenmark was introduced late 1923, backed not by gold in the classical sense, but by claims on real assets and a credible constraint on issuance. The monetary regime changed because the old one had forfeited the right to be believed. And in that transition, hard assets became the bridge. People didn't need a thesis on macroeconomics to understand it. They needed survival tools, gold coins, foreign currency, tangible goods, anything that was not a domestic promise, traded at premiums. Physical metal became a truth serum. Paper claims, denominated in a dying unit, became less credible by the week. Hold that picture. Foundation that can't bear its obligations, expansion to postpone the reckoning, FX and inflation exposing the contradiction, and a reset that admits the old unit was not stable. That's one case. Now fast forward to a modern reserve currency moment where the costumes changed but the mechanism stayed intact. The end of Bretton Woods and the inflationary decade that followed. After the Second World War, the foundation stage was elegant. Bretton Woods created a system where the dollar sat at the center, convertible to gold at $35 an ounce for foreign official holders, while other currencies were pegged to the dollar. It was sold as stability, cooperation, a framework to rebuild, and it worked until it worked too well, because that foundation made the dollar not just a currency, but a global settlement instrument. World trade expanded, global reserves accumulated, and the demand for dollars grew far beyond what a single country's gold stock could credibly back. Then came the expansion phase, and it came through policy and necessity. The U.S. ran deficits for war and domestic programs. Dollars flowed overseas. Foreign central banks accumulated dollar reserves. On paper, the promise of convertibility remained. In practice, the U.S. was issuing more claims than it could honor at the old price. That's not a moral judgment. It's an arithmetic observation. The euro-dollar market, offshore dollar banking, expanded outside direct U.S. control, multiplying dollar credit globally. Liquidity cycles began to take on a life of their own. When dollars were plentiful, global growth surged and risk appetite expanded. When dollars tightened, stress rippled outward through FX and funding markets. The seed of today's dollar system was planted right there. Dollars as global oxygen, created by banks, recycled by trade, demanded in crises. Loss of control arrived when the contradiction became visible. Foreign official holders, looking at U.S. gold reserves versus outstanding claims, started to doubt the $35 promise. Gold outflows intensified, confidence frayed. In August 1971, the U.S. closed the gold window. Nixon suspended convertibility. It was framed as a temporary measure, a defense of stability. But the outcome was irreversible. The foundation was gone. The dollar became a pure fiat reserve currency, supported by state power, economic size, and, critically, by the world's continued need for dollar liquidity. Once the anchor was cut, the rest of the mechanism accelerated. The expansion debasement phase expressed itself through inflation transmission. In the 1970s, oil shocks hit, but the deeper vulnerability was monetary. A currency regime unmoored from gold with fiscal pressures and political constraints against tightening. Inflation rose, and it was not a clean consumer price story. It was an everything story: wages, commodities, expectations, and crucially, bond yields. Bond markets began to demand compensation. Nominal yields climbed as inflation expectations rose, and volatility became a feature, not a bug. When yields rise, the cost of financing rises. When the cost of financing rises, the political system looks for relief. Relief often means easier money. Easier money reinforces inflation. The loop tightens. By the late 1970s, the crisis loss of control phase became undeniable. The dollar weakened, inflation surged. Real yields were crushed. The funding markets were not broken, but they were shouting. That shout is what markets always do before a regime change. They force the issuer to choose between defending the currency and defending the system's solvency. That is the trap. Defend the currency aggressively, and you risk breaking the leveraged structure that depends on cheap funding. Defend the structure with liquidity, and you risk sacrificing the currency's purchasing power. The choice is never clean. The choice is always painful. And because it is painful, policymakers tend to delay until the market removes the option to delay. The outcome in that era required a shock. Volcker's tightening in 1979-1981 was not a policy tweak. It was a violent regime assertion. Rates up, liquidity constrained, a willingness to impose recession to restore credibility. Bond yields spiked, volatility exploded, funding conditions tightened, asset prices suffered. But the point was to break the inflation psychology and re-anchor the dollar. Notice how the mechanism resolves. Either you accept devaluation and inflation as the reset, or you accept a tightening shock and recession as the reset. In both cases, something real must give, because the prior promises cannot all be kept simultaneously. And where do precious metals sit in this mechanism? Right at the nerve. In the 1970s, gold repriced dramatically as the market processed the end of convertibility and the inflation that followed. Silver became a volatility amplifier, a metal with monetary history and industrial demand pulled into speculative currents. The public remembers the headlines, the Hunt brothers, the spike, the crash, but beneath that drama is the structural point. When monetary credibility is questioned, metals become a referendum. Not because metals are magical, but because they are outside the liability stack. A treasury bond is a promise to pay dollars in the future. A bank deposit is a promise to deliver dollars on demand. A futures contract is a paper claim settled inside a financial system. A bar of gold or a stack of silver rounds is not someone else's promise. In crisis, that difference stops being philosophical and becomes mechanical. This is where the paper versus physical distinction matters. And it matters in a way most people ignore until it's too late. In calm times, futures and forwards provide price discovery and inventory is assumed. In stress, delivery matters, premiums matter. The question becomes, can paper claims be converted into the thing they reference without friction? In metals, that friction shows up as widening spreads, rising premiums over spot, delays, tighter lease rates, and inventory drawdowns at the very places people assume are bottomless. When financial conditions tighten, when dollar liquidity is scarce and collateral is prized, participants who once rolled paper claims without concern suddenly care about settlement risk. They care about whether the system can perform under strain. Now, connect those historical mechanisms back to the core claim. Regime change is not a surprise event. It is a sequence. It begins in the foundation stage with a framework that seems stable. It expands through credit and promises that outrun the real base. It enters loss of control when FX, inflation, deflation dynamics, and funding markets expose the contradiction. And it ends with an outcome, either a formal reset or an implicit one, through sustained repricing that restores equilibrium by redistributing losses. The names change, the instruments modernize, but the skeleton remains. The modern dollar system is more complex than Weimar's printing press and more sophisticated than Bretton Woods' peg, but that complexity doesn't eliminate the pattern. It can even intensify it because complexity increases interdependence. Today's system runs on Treasury collateral, on repo funding, on swap lines, on derivatives that assume liquidity, on global banks that intermediate offshore dollar credit, on FX markets that clear stress instantly. Inflation and deflation can coexist. Inflation in essentials when supply chains and currency weakness bite, deflation in assets when yields rise and liquidity tightens. That coexistence is not a contradiction. It's what happens when the pricing of money itself becomes unstable. And once the pricing of money becomes unstable, bond yields stop being a number on a screen and become a governing force. Every auction becomes a test of confidence. Every rollover becomes a moment of truth. Every basis move in FX becomes a signal of who is scrambling for dollars and who is trying to escape them. Volatility stops being a risk-on risk-off mood and becomes a mechanical consequence of leverage meeting higher funding costs. In that world, gold and silver don't need a story to move. They move because they sit at the intersection of trust and settlement. They become the pressure gauges. That brings us to the point where you should feel the tension rising, not because of a rumor, but because the sequence is advancing. Two major regime shifts, Germany's post-war collapse and America's post-gold window inflation shock, show the same skeleton. Promises outrun reality. Liquidity is used to bridge the gap. FX and yields expose the break, and the system resets through repricing and pain. The only question is not whether the mechanism exists. The only question is where we are in it right now, inside the dollar machine, inside the global funding markets, inside the auction calendar, inside the quiet places where stress appears first, before it becomes visible to everyone else. Why gold and silver become the only pressure valves? Left that question, where we are in the sequence, is not answered by speeches. It's answered by stress signatures in the machinery. Before we step into today's plumbing, there's one more proof point, because the modern version of this mechanism isn't a sepia-toned history lesson. It's a late 20th century case where dollar liabilities, FX pegs, bond markets, and liquidity cycles collided in real time and in public. The Asian financial crisis, 1997-1998. It's the cleanest example of how a system can look stable for years, right up until the currency mismatch snaps, the dollar becomes scarce, and the entire structure reprices in weeks. The foundation stage in Asia wasn't chaos. It was a deliberately engineered stability story. Thailand effectively managed the baht against a dollar-heavy basket. Other economies in the region operated quasi-pegs or tightly managed currency bands. That stability attracted capital. It encouraged banks and corporates to borrow in dollars because dollar funding looked cheap, predictable, and safe under a stable FX regime. Domestic credit expanded. Real estate and equity markets inflated. Current account deficits were tolerated because inflows were strong and the peg gave everyone psychological permission to ignore currency risk. This is the part of the pattern people always misunderstand. The system's apparent strength becomes the justification for leverage that only works if the apparent strength never changes. Then the expansion phase arrived, and it arrived as a balance sheet phenomenon. Banks and companies took on short-term dollar liabilities and long-term local currency assets. That is the original sin in one sentence. Borrow in a currency you can't print. Invest in assets that can't be liquidated quickly, and assume rollover will always be available. The peg made that assumption feel rational. It wasn't. It was a mathematical bet that reserves, confidence, and foreign capital would remain infinite. And the moment the market doubts that, the peg becomes a trap. Loss of control began as it always does. FX pressure that looks manageable until it isn't. Speculators tested Thailand's reserves. Authorities defended the currency by selling reserves and tightening domestic financial conditions. But here's the key. Defending a currency peg under capital flight forces you to drain liquidity from your own system. You can either keep liquidity flowing and let the currency go, or you can defend the currency and strangle your banks. Those are the only two doors. As reserves bled, the market understood the math. In July 1997, Thailand abandoned the peg and devalued. The devaluation didn't merely move a chart, it repriced liabilities. Dollar debts exploded in local terms overnight. Corporate balance sheets that looked fine at one exchange rate became insolvent at another. Contagion spread because the mechanism was shared across the region. Similar pegs, similar dollar borrowing, similar maturity mismatches. The crisis phase accelerated through funding markets, not ideology. When a regional system has dollar liabilities and the dollar rises against local currencies, the demand for dollars becomes reflexive and self-reinforcing. Borrowers scramble to buy dollars to service debts. Banks scramble to secure dollar funding. FX hedges become expensive or unavailable. Spreads widen. Liquidity disappears. Risk assets collapse because they were priced for abundant, cheap financing. And when the panic hits, the IMF programs and austerity narratives become the after effects, not the cause. The cause is mechanical. A large, levered structure funded in dollars cannot survive a regime where the dollar tightens and the peg breaks. The outcome stage was a reset through devaluation, restructuring, and a new relationship with external funding. Some economies implemented capital controls, most famously Malaysia in 1998, explicitly choosing financial sovereignty over market access. Others accepted IMF frameworks, absorbing recessions and forced adjustments. But the deeper outcome was universal. The region learned that a currency regime built on external dollar liabilities is only stable as long as the dollar is abundant and global risk appetite is generous. When those conditions reverse, stability turns into fragility. That is the modern proof point, and it maps perfectly to the sequence. Engineered stability, leverage built on that stability, FX fracture exposing the mismatch, and reset through pain. Now we apply the same mechanism to the present, step by step, in the dollar system that sits above everything. The foundation of today's regime is not a gold peg or a treaty. It's the dollar's role as settlement unit, reserve asset, and collateral base. The U.S. Treasury market is the core collateral pool for global finance. Banks, dealers, hedge funds, corporations, and foreign central banks treat treasuries as the cleanest collateral for repo and derivatives margin. The plumbing is built around the assumption that treasuries are always liquid, always financeable, always money-like. In practice, the dollar that matters is not the cash in your wallet. It's balance sheet capacity to intermediate collateral and create dollar credit through repo, swaps, and offshore bank lending. Check. The expansion phase in the present era is visible in the scale of rollover dependency. The U.S. funds large deficits by issuing bills, notes, and bonds that must be refinanced continuously, while the global system accumulates dollar liabilities that must also be rolled, hedged, or serviced. When rates were pinned and volatility was damped, this looked effortless. Cheap funding encouraged duration risk, leverage, and carry strategies. That includes the basis trade, levered positions that harvest small spreads between Treasury cash bonds and futures, financed in repo. It includes corporate borrowing that assumes refinancing windows stay open. It includes foreign holders accumulating treasuries while using swaps to manage currency exposure. All of that is stable only when funding is smooth, collateral is easy, and volatility stays low. The moment those assumptions break, the expansion phase reveals what it really was, a structure that requires constant liquidity injections to function without stress. Verified. Now move into the crisis signature. FX and global currency stress. When the dollar strengthens, whether due to higher U.S. real yields, a flight to safety, or relative growth differentials, it exports tightening to the rest of the world. That tightening is not rhetorical, it's contract-based. Dollar debts become harder to service in local currency terms. Import prices rise for dollar-priced commodities, transmitting inflation even if domestic demand is weak. Meanwhile, to defend local currencies and prevent capital flight, foreign central banks may hike rates or intervene, draining domestic liquidity. That creates a brutal dual squeeze, inflation from a weaker local currency and deflationary pressure from tighter financial conditions. You don't get one clean macro outcome. You get a tug of war that destabilizes politics and markets simultaneously. Undeniable. Next step, inflation and deflation dynamics inside the U.S. itself. A regime under stress often produces inflation in essentials and deflation in financial assets at the same time, because yields are the transmission belt. If nominal yields rise and term premium rises, meaning the market demands extra compensation for holding duration, then discount rates climb and risk assets reprice lower. That's deflationary for equities, real estate, and credit. But if the currency's purchasing power is questioned and supply chains remain constrained, the cost of necessities can remain sticky or reaccelerate. Add fiscal reality, large interest expense as debt rolls at higher rates, and you get a policy bind. Tighten aggressively to crush inflation, and you risk a funding accident. Ease to protect funding, and you risk reigniting inflation expectations. Either path confirms the loss of control stage because it proves the system cannot satisfy all constraints at once. Check. Now, the debt rollover and auction mechanism, the place where the abstract becomes measurable. Treasury issuance is not a concept. It's a weekly clearing process. Each auction asks, will dealers and investors absorb new supply at yields the state can tolerate? Watch bid to cover ratios, the share taken down by dealers, and auction tails when the auction clears at a higher yield than expected, signaling weak demand. In a tightening regime, you tend to see softer bid to cover, heavier dealer participation, and wider tails because buyers demand concession. Concession means higher yields. Higher yields raise interest costs. Higher interest costs expand deficits. Expanded deficits require more issuance. More issuance tests demand again. That feedback loop is not theory. It's the arithmetic of rollover finance. Verified. Now watch yields with the right lens. The danger isn't just rates up. It's the combination of rising term premium and unstable real yields. When real yields rise, they tighten financial conditions globally and strengthen the dollar, increasing currency stress abroad. When term premium rises, it tells you the market is demanding compensation for uncertainty, fiscal uncertainty, inflation uncertainty, volatility uncertainty. That is a regime signal. It means the market is no longer willing to finance long duration as if it were risk-free. It is repricing the entire liability stack. Undeniable. Next, funding markets and dollar liquidity. If you want to know whether the system is calm or stressed, stop staring at equities and watch repo, swap spreads, and the cost of dollars offshore. When repo rates spike relative to policy benchmarks, it often reflects collateral scarcity or balance sheet constraints. When swap spreads behave strangely, it can reveal stress in dealer intermediation, hedging demand, or the relative value between treasuries and swaps. When the cross-currency basis widens, it signals that borrowing dollars via FX swaps is becoming more expensive, meaning global demand for dollar funding is outstripping supply. These are the places where the machine whispers before it screams. Check. Now layer in the basis trade and collateral dynamics because this is where boring but terrifying becomes lethal. Levered relative value trades depend on stable funding and low volatility. When volatility rises, margin requirements rise. When margin requirements rise, players must either add collateral or reduce positions. Reducing positions means selling. Selling pressures prices, which increases volatility, which increases margin again. In treasuries, that can create dysfunctional liquidity. Large moves in what is supposed to be the world's safest market. If treasuries become volatile collateral, repo haircuts can rise, further tightening funding. That's a self-reinforcing liquidity squeeze. The system's core collateral begins to behave less like cash and more like risk. Verified. Now the spillover into risk assets is not optional, it's mechanical. When the risk-free rate rises and funding tightens, equities re-rate lower, credit spreads widen, and leverage structures unwind. Volatility becomes endogenous. It is created by the act of deleveraging itself. You see it in abrupt drawdowns and gap moves and correlation spikes where everything sells together because everything is funded together. In that environment, liquidity is not available at a price. Sometimes it is simply not there because the intermediaries step back. That's how regime shifts feel in markets. Not a gradual repricing, but a sudden absence of bids. Undeniable. And this is where gold and silver enter as stress valves. Not as a fairy tale, but as the pressure relief the system reaches for when trust in paper claims wobbles. In a liquidity squeeze, paper assets are sold to raise dollars. Gold can drop in the first wave because it is liquid and can be sold. Silver can drop harder because it is thinner and more volatile, and because leveraged positioning gets blown out. But then the second phase begins. Once the immediate dollar scramble passes, the market starts asking a different question. What sits outside the liability stack? That's where precious metals reassert themselves. Not because they generate yield, but because they do not require a counterparty to perform. Check. Now we get precise about the paper versus physical mechanics because this is the telltale signature of regime stress. Futures markets and ETFs represent claims and exposure. Physical markets represent delivery, availability, and trust. In calm periods, you can trade paper claims all day and assume convertibility. In stress, you watch for premiums rising over spot, widening bid-ask spreads in coins and bars, delayed delivery times, and inventory drawdowns at warehouses. You watch whether the price on a screen matches the price demanded for immediate, verifiable metal in hand. You watch whether lease rates and forwards imply tightness, signals that holders prefer possession over yield. When those gaps appear, they are not a conspiracy, they are a rationing mechanism. The market is telling you the marginal unit is scarce at the margin that matters. Deliverable supply, not paper claims. Verified. Silver has its own additional torque because it straddles monetary psychology and industrial demand. In a growth scare, industrial demand expectations can pressure price, intensifying volatility. In a currency trust scare, investment demand can surge, tightening physical supply chains quickly because the market is smaller and more sensitive to retail and wholesale flows. That is why silver often behaves like a coiled spring. It can look weak during liquidation, then snap violently when the stress rotates from "I need dollars now" to "I don't trust promises later." Gold is the reserve metal. Silver is the volatility amplifier. In a regime shift, you should expect swings that feel unreasonable, because they are the byproduct of liquidity and positioning, not just fundamentals. Undeniable. Now put the steps together as the present-day mechanism. The dollar's centrality makes it the world's funding constraint. Higher real yields and term premium tighten that constraint. FX markets transmit stress outward and back again. Inflation and deflation collide across different sectors. Debt rollovers become recurring confidence tests at auction. Funding markets reveal balance sheet limits. Leverage unwinds into volatility. And precious metals absorb the trust premium as paper claims are questioned and physical constraints reappear. This is not a story about one price chart. It's a story about the integrity of the settlement system. Check. So what do you do with this, practically, without becoming someone else's liquidity exit? You stop watching only the headlines and start watching the signals that precede them. Track the dollar's direction against a basket, but more importantly, watch stress measures that reveal dollar scarcity, cross-currency basis, dollar funding spreads, repo conditions, and whether Treasury auctions are clearing cleanly or with persistent tails. Watch term premium and real yields because they are the fulcrum. When they rise, liquidity tightens even if policy rates don't move. Watch swap spreads and credit spreads because they reveal where the intermediaries are choking. Watch volatility not as fear, but as a margin regime, rising vol forces deleveraging. Then watch the metals market at the street level. Premiums, delivery delays, inventory trends, and the gap between paper price and physical availability. If those gaps widen while funding markets are stressed, it's telling you the system is shifting from price discovery to trust discovery. Verified. And now the final warning has to be spoken plainly, because the human instinct is to reach for comforting myths at exactly the wrong moment. This time is not different. American exceptionalism is not a force field against arithmetic. Tech will save us is not a funding plan when the term premium rises and the rollover calendar doesn't care about innovation. Modern optimism is not collateral at a repo desk, and it doesn't improve a bid-to-cover ratio. The system can remain functional for longer than skeptics think, and then it can change faster than optimists believe. The people who get trapped are the ones who assume the exit will be wide, liquid, and polite. In regime change, the exit is narrow, liquidity is rationed, and the price of delay is paid in slippage. If you want to stay on the right side of the shift, think like the system. Ask every week whether funding is getting easier or harder. Ask whether auctions are clearing smoothly or demanding higher yields. Ask whether the dollar is exporting stress through FX. Ask whether volatility is forcing deleveraging. Ask whether physical metals are becoming scarce at the margin while paper claims still trade effortlessly. And above all, refuse to be the last buyer of a crowded trade financed with fragile liquidity. When you feel the regime turning, the goal isn't to predict the exact day. The goal is to avoid being positioned in a way that requires perfect liquidity to survive. Undeniable. Stay close to these signals because they are the language of the machine. If you keep tracking them with me, you'll see the next stage forming before it becomes obvious on the evening news. And in the next video, we'll walk through how this machine was built, why the pressure keeps rising, and what it looks like when the final phase hits markets that are still pretending it can't. The verdict is calm, not dramatic. The dollar system is tightening its own constraints, and the world is already adjusting in ways most people won't recognize until the adjustment has already priced them out. Will you be watching the signals or watching the headlines?